that the Fed obviously has a bit of a different take. I want to ask you, a lot of people believe that we're heading towards a recession, and also a lot of people believe we're going to get a quarter-point rate hike coming up in the next meeting. How does this compare to the environment before the Great Recession back in 2007 and 2008? Were we expecting to see, was there a rate hike back then as well?
No, and so this is unusual for the Fed staff to present to the FOMC and say, we're putting a recession in the forecast. Our base case now is a mild recession. You do not normally see that. You did not see that before the recession of 2007 to 2009. In fact, through the summer of 2008, if you look at the minutes, the staff forecast was saying growth is going to slow down here in the second half of the year, but then it's going to pick up in 2009. Of course, what's different now is you have core inflation quite sticky above 4.5%. And the one thing that has traditionally gotten inflation to come down has been a recession.
All right, so you just mentioned inflation. We saw that CPI report yesterday. CPI overall in line, overall CPI just a tick lower, a little bit cooler than expected. Core CPI was in line. We also have another inflation report, the Fed's actually preferred gauge, PCE, coming up on April 28th. So that's obviously just days before that May meeting. Was there anything in this CPI report that you think would be especially meaningful for the central bank?
Well, the Fed will be able to take the CPI report and the PPI report and come up with a pretty good idea of where the PCE is going to come in. I think what could be more interesting would be tomorrow's retail sales report, because the retail sales report is going to give maybe the first look at how consumption activity, consumer spending responded during March when we were seeing that banking stress. So you have retail sales, and then you have the employment cost index at the end of April. And, that's a very high fidelity report for the Fed. They pay a lot of attention to it. It's a better measure of wage growth than probably anything else out there. And so they'll be looking at what happened with earnings, for workers in the first quarter. And I think the question for the May meeting really is, how much weight are they going to put on the hard data versus some of the sentiment survey data, anecdote around how the banking stress is influencing activity.
All right, so you're mentioning earnings for workers. What about earnings for the big banks? That starts on Friday. Obviously, the banks are a big concern for the central bank. How much is this, what we're going to see from JP Morgan, Wells Fargo, these other big banks, how much is that going to weigh on that eventual rate decision?
Well, I think what's more interesting than the big banks are the mid-sized banks. And if you think back to what triggered this whole mess with Silicon Valley Bank, it was that disclosure that they were going to raise capital on March 8th. That's what kicked off the run on March 9th. So the question here will be, are there any sort of disclosures in these earnings for the mid-sized banks that make people say, oh, wait a minute, this kind of deposit erosion is worse than we thought? And does that create another round of tumult in bank equities? And that would be the sort of thing that the Fed would pay attention to if it suggested that there were more acute stresses coming back into the system. The Fed did not want to hike into a mess in March, and they were able to get things calmed down enough over that last weekend, especially because of what the Swiss did with UBS and Credit Suisse. So I think that'll be the issue here: is can these stresses remain more calm, more mild, and that allows the Fed to judge that, they can continue to move ahead with monetary policy because the banking issues aren't going to slow down the economy as much as might otherwise be the case.